Hello and welcome to this video. In this video, we are going to do a A-level question from paper 3, May-June 2023, variant 32, question 3. The question states that Alice and Bob had been in partnership for many years, engaged in trading of food. They shared profits and losses in the ratio of 3:2. The total contributed capital was $250,000. Each partner contributed capital on the basis of profit sharing ratio. On 1st January 2023, they agreed to sell the business to X Limited, also a trader of food, for $420,000. X Limited took over all the assets except cash at bank and a vehicle. The asset taken over were revalued as follows. Carrying value and the revalued value is given. For premises, it is $124,000 and $186,000. Equipment is $38,000 and $32,000. Vehicle, one of the two vehicles, is $23,000 and $18,000. Inventory is $32,000 and $45,000. Trade receivables are $73,000 and $71,000. The total carrying value is $290,000 and revalued amount was $352,000. Further information is also available. Alice took over the second vehicle carrying value of $25,000 at the value of $23,800. Next, we have the trade payables of $44,000 were settled after taking a cash discount of 5% and were paid out of partners' bank account. The cash at bank at 31st December 2022 amounted to $27,000. The purchase consideration was settled by 200,000 ordinary shares of $1 each at the value of $1.60 per share. The balance was paid in cash. The ordinary shares were issued to Alice and Bob equally. Alice and Bob had a credit balance on their current accounts at 31st December 2022. The balance of Alice's account was twice that of Bob's. The current accounts were transferred to their respective capital accounts on 1st January 2023. In the A bit of the question, we are asked to state two reasons why a business may acquire another business. There are various reasons why a business may acquire another business, like this helps them to gain more efficiency because of the various economies of scale like purchase economy, marketing economy and production economy. Thus, this leads to more efficiency. Then this also leads to growth because whenever there is a takeover or a merger, then the company acquires the market share of its competitor business. Hence, this leads to more growth. Then it also helps to increase the expertise. Whenever there is a business which is of a bigger size, people of expertise, that is professionals, like to work in a bigger business than a smaller one. Hence, we can employ specialists, and the bigger size of the business will also justify employing these specialists. Then it also helps in eliminating the competitor. Whenever there is a takeover or a merger, we eliminate the competitor by taking their market share. Furthermore, this can also help in entering new markets. Whenever a business wants to go for diversification or enter a new market, they can buy the existing business so that it will be easy for them to grow and gain efficiency. So these are the various reasons why a business may acquire another business. In the B bit of the question, we are asked to prepare the realization account at 1st January 2023. You see, at the time of dissolution of firm, all the books of accounts are closed. And what we do is we sell off all the assets and we pay off all the liabilities. And for this purpose, we make the realization account, which is a nominal account. And the purpose of making this account is to know whether the firm have made a profit or loss by realizing its assets and liabilities. So we'll start making the realization account. So in realization account, what we will do is when we close the assets account, the closing balance will be on the credit side. Now we are going to bring down all the balances of these assets at net book value or the carrying value in the realization account on the debit side. So we will mention this on the debit side, except we will not mention the cash in hand or cash at bank. Apart from that, all the assets will be debited at their net book value, and here we got the net book value of the assets, which was given as $290,000. Furthermore, there was one more vehicle which was taken over by Alice, and for this the net book value was $25,000. On the credit side, we will write all the receipts which we got by selling the assets, And here we have sold this assets to X Limited, who have purchased this partnership firm, and they have paid a purchase consideration of $420,000. Furthermore, this vehicle which was taken over by Alice will be paid from Alice capital account, and Alice is going to pay $23,800 for this asset. Now, as we are done with all the assets, let's deal with the liabilities. The liability which was mentioned was the trade payables of 44,000 and were settled after taking a cash discount of 5% and were paid out of partner's bank account. So this will be credited, that is 44,000 will be credited to the partner's bank account. However, we got a 5% discount, so 44,000 times 5% will be $2,200, and this will be an income on realization, and hence we are going to credit it because we have the rule for normal account: debit all the expenses and losses, credit all the incomes and gains. So as this is an income, we are going to write discount received, and we are going to mention $2,200 on the credit side. Now we are done with all the liabilities and assets. Now we are going to balance the realization account. When we total the credit side, we get the total as $446,000. And on the debit side, we have $290,000 plus $25,000, which will be $315,000. So our credit side, that is the income and gain side, is more, and hence we will have profit on realization, which will be the difference between $446,000 minus $315,000, and that will be $131,000. And this profit belongs to the partners, hence this will be divided among the partners in the profit sharing ratio. And we have the profit sharing ratio between Alice and Bob as 3:2. So it will be 131,000 times 3 divided by 5 for Alice, and that will be $78,600, and this will be transferred to Alice capital account. And for Bob, it is 131,000 times 2 by 5, which will be $52,400, and together the total will be $131,000. And now here the total of the debit side and the credit side is same, that is $446,000. So we have balanced the realization account. In this bit of the question, we are asked to prepare partner's capital account at 1st January 2023 to close the partnership books of account. So what we are going to do is we are going to do all the calculation related to the capital account in our working notes, and then we will proceed and make the capital account. So the information which was given related to the capital account, the first information which we have here is Alice and Bob had a credit balance on their current accounts at 31st December 2022. The balance on Alice's account was twice that of Bob's. The current account were transferred to their respective capital account on 1st January 2023. You see, whenever we talk about the partnership's capital account, most of the firm, what they do is they maintain the capital account as fixed, and only the investment which was initially paid as capital, or if there is any reinvestment in the capital, is mentioned in the capital account. And all the other fluctuations like the salary which is paid to the partners, or the share of profit which have to be shared between the partners, or the interest on capital, all this is maintained in a separate account which is called as the current account. So here the capital consists of both the balances, that is the capital account balance plus the current account balance. And here we don't know the amount or the value for the credit balance which have to be transferred to the Alice and Bob capital account as we are closing the book. So for this, what we are going to do is we are going to use the accounting equation which states that assets is equals to capital plus liability, and as we want to find the capital, so we will transpose the liability to the other side. So now our capital will be equal to assets minus liability. As I have mentioned here, the capital will consist of both the capital account balance plus the current account balance. This capital account balance was given. So now what we are going to do is we are going to change the capital with capital account balance plus the current account balance, and from there again we are going to use the same equation, that is equal to assets minus liabilities. And now again we are going to transpose this capital account balance to the other side so that we can get the current account balance. So now our current account balance will be equal to assets minus liabilities minus the capital account balance. So for assets, what we have is the book value of assets or the carrying value of assets which was given was $290,000. And furthermore, there was one more asset which was taken up by Alice, and this was a vehicle, and the value which was for this vehicle was $25,000. So these are the assets, plus we have cash at bank which is also our current asset. So we will add this, that is 27,000 will be added. And when we add all this, from this we will subtract the liabilities. So when we subtract the liabilities, here we have trade payable, and the value which was given was $44,000. So when we subtract this, we get the net value of assets which will be $298,000. That is, we are done till the part where we have taken the assets, and from there we have subtracted the liabilities. Now we are going to subtract the capital account balance which was given in the beginning of the question as $250,000. So when we subtract this, we get the current account balance as $48,000. Furthermore, the information which was given was that Alice account was twice of Bob. So this will be a ratio of 2:1. So when we take this ratio and divide this $48,000, for Alice current account balance will be 48,000 times 2 by 3, which will be $32,000. And for Bob, the current account balance will be 48,000 times 1 by 3, which will be $16,000. Furthermore, the capital of the partnership firm was paid by X Limited by issuing ordinary shares, and this was mentioned in the purchase consideration as 200,000 ordinary shares of $1 each at a value of $1.60 per share were issued. So here the face value of share is $1. So our ordinary share capital will be 200,000 times $1, that will be $200,000. Furthermore, the 60 cents will be our share premium. So for the share premium, it will be 200,000 times 60 cents, it will be $120,000. So when we add this up, it will be $320,000. And furthermore, the information which was provided states that the ordinary shares were issued to Alice and Bob equally. That is, the ratio should be 1:1. That is, the amount, that is $3,200, should be divided equally. So it will be half for Alice and half for Bob. So Alice's share will be 320,000 times half, which will be $160,000, and for Bob it will be 320,000 times 1 by 2, it will be $160,000. Furthermore, it was mentioned that the total contributed capital was $250,000. Each partner contributed capital on the basis of the profit sharing ratio, which was given as 3:2. So Alice's share of capital will be 250,000 times 3 divided by 3 plus 2, which will be 5. So it will be 250,000 times 3 by 5, which will be $150,000. And Bob's share of capital will be $250,000 times 2 by 5, which will be $100,000. Now let's close the partner's capital account. You see, based on the accounting equation, we have a rule that capital and liability will have the opening balance on the credit side, and whatever increases the capital should be credited, and whatever decreases the capital should be debited. So we'll have the opening balance of our capital on the credit side, and this was calculated in the third working notes, and the balance which we got for Alice was $150,000 and for Bob it was $100,000. The current account, again, this is a part of the capital and increases our capital. Hence, as we have calculated this in the first working notes, we got the value for Alice as $32,000 and for Bob it was $16,000. Then the profit on realization, as this increases the capital, hence we are going to write it on the credit side. This was calculated in the realization account in the bed B of the question. So we are going to take the value from there. For Alice it was $78,600 and for Bob it was $52,400. So now we are done with all the credit entries. Now we will proceed and check the debit side of the partner's capital account. On the debit side, we are going to pass all the entries by which we are going to pay this total capital balance for both the partners. So we'll start with the ordinary shares which was issued by X Limited to purchase the partnership firm, and we have calculated this in our second working notes as $160,000 for Alice and $160,000 for Bob. Furthermore, Alice have taken a vehicle at the time of dissolution and this have to be paid from the capital account. So Vehicle, $23,800 will be paid from the Alice capital account. Now, if we see the total amount of capital which need to be paid to Alice was $260,600. From this, $160,000 and $23,800 is paid. So we subtract these two amounts, we get the balancing figure as $76,800. Now, as we are closing the partnership firm, this will be paid from the partnership bank account. Next, for Bob, we have to pay $168,400, and out of this, $160,000 was paid. So the balancing figure, that is 8,400, will be paid from the partnership bank account. Now, if we total, both the sides are same, and with this, we have closed the partnership capital account. In the debate of the question, we are asked to prepare the journal entries in the books of X Limited to record the acquisition of the partnership. Narratives are not required. Now, as we are recording the journal entries in the book of X Limited, it will be from the point of view of X Limited because we are recording the journal entries in their book. So we'll start with the sundry assets, that is the assets which are taken over by X Limited, and the value which we are going to mention will be the value which X Limited have paid. That will be the revised value, and as assets are increasing, hence we are going to debit them. Then goodwill. If X Limited have paid more than the value of asset, that means there was a goodwill or the good reputation of the business or good loyalty of the customers towards the business, because of which, because of the brand name or because of the good name of the business which is acquired, X Limited was willing to pay a higher price, and that will be the goodwill, and this will be the balancing figure, that is the difference between the credit and the debit balance. Then we have sundry liabilities. If X Limited had taken over the liabilities of the partnership firm, then that will also be recorded, and as the liability increases, it should be credited. However, here X Limited has not taken over any liabilities, so we may not have sundry liabilities. And the means by which X Limited have paid, that is the business consideration by which the assets have been paid off, and this increases the overall capital and the liability of X Limited. Hence, this have to be credited. So, the difference between this total, that is the total of credit. From there, when we subtract the sundry assets, if there is some value remaining, that will be the balancing figure, and that will be the goodwill. So now this is how we are going to pass the journal entries in the books of X Limited. So now let's calculate the goodwill before passing the journal entry. As I have mentioned, to get the goodwill, what we are going to do, we are going to take the purchase consideration. If there are any liabilities which have been taken over by the limited company, that will also be added. However, in this case, we don't have any liabilities which have been taken over by X Limited. So we are going to take the purchase consideration. From there, we are going to subtract the value of sundry assets at which the X Limited have taken over the partnership firm, and then we will see whether we have goodwill. So we'll start with the purchase consideration. It was given that the purchase consideration was $420,000, and this consists of 200,000 ordinary shares, and the face value of the share was $1, and this was issued at a price of $1.60. So our ordinary share capital will be 200,000 times 1, which will be $200,000, and this 60 cents will be the share premium, that is 200,000 times 60 cents will be $120,000. The rest of the value, that is the balancing figure, was paid by cash. So out of this $420,000, when we subtract $200,000 and $120,000, the balancing figure which was paid in cash was $100,000. So now if we see the purchase consideration which was paid was $420,000, and the net value at which the assets were taken over, that was the revalued amount which was given, was $352,000. So now the difference between this two, that is $420,000 minus $352,000, which will be $68,000. This will be the goodwill. Now we'll proceed and pass the journal entry. The rule for journal entry is again based on our accounting equation. Any increase in assets should be debited, any decrease in assets should be credited, any increase in liability or capital should be credited, and any decrease in liability and capital should be debited. So here the assets have been increased, so we are going to debit them. We have premises and the value is $186,000. Equipment, the value is $32,000. Vehicles, the value is $18,000. Inventory, the value was $45,000. Trade receivable, the value was $71,000. And the goodwill, this is also a intangible asset, and as this is asset, we will debit it, and we have calculated this in our working notes, and the value which we got was $68,000. Then there is increase in the capital. As I told you, increase in the capital or liability should be credited. So ordinary share capital which was issued was $200,000, and the share premium which we got was $120,000. So these two are credited. Furthermore, there will be a decrease in the cash or the bank balance because we are paying this to the partnership firm, and whenever there is decrease in the value of asset, it should be credited. So we are going to credit this $100,000. So this is how we are going to pass the journal entry for X Limited. In the EBIT of the question, we are asked to advise Alice whether or not she should set up this new business, and we have to justify our answer. First of all, you have to state what you advise, which will fetch you 1 mark. And from my point of view, I will say that Alice should set up the new business, and I will support it with these reasons, that is, she has experience and knowledge in trade because she was already running the business as a partnership firm with Bob. So she has experience and she has knowledge, she knows the suppliers, she knows the customers, so this will be very helpful for her to run her own business. Furthermore, now she is not having the partnership firm to run, so she will have more time for herself because the limited company will be run by the directors and she will get the dividend. However, she will have more time on her hands and she can use this to run her own business, and this will fetch her more money, that is, from the limited company she will get dividend, plus she can earn more profit by running her own business, and this all profit will belong to her. So based on this, I will suggest that Alice should start the new business. However, if you want to suggest that Alice should not start the new business, then you can say that she will be in competition with X Limited, and X Limited is a company, so the competition will be tough, and because of this, she should not start her own business. Furthermore, she have to pay the startup cost, and she have to make sure that the cash she received from the purchase consideration of X Limited is sufficient to fulfill the startup cost or not. If it is not sufficient, then she have to go for liabilities, and as she is going for a sole trader business, sole traders will have unlimited liability, so she have to make sure that she is able to fulfill the liabilities. If not, her personal assets will also be tied up to the loan, and this may lead to more problems. So you have to mention what you advise, you can state why you support this advice, and you can also state what will be the problems she will face and how she should overcome. So with this, we have completed this question. Thanks for watching my videos. Have a great and peaceful life.